Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing some intriguing shifts in Ontario's housing market. A recent market insights forum hosted by Terranet has revealed significant changes in buyer and seller profiles across the province. According to the data presented, Ontario's housing market has experienced a reset, with evolving participation among different groups as they respond to changing market conditions. Emily Chung, Director of Data, Analytics and Insights at Terranet, highlighted that despite recent easing of interest rates, the anticipated market recovery has not materialized. Chung shared insights gleaned from Ontario Land Registry data, providing a clearer picture of the current real estate landscape. This data is crucial for understanding the market's dynamics as we navigate through ongoing uncertainties. One of the key findings is the contrast between the overall provincial market and Toronto's unique trends. While condos account for 25% of land transfers across Ontario, they make up a whopping 60% in Toronto. In Toronto, condo sales saw a 20% increase year over year as of 2024, compared to a modest 4% rise in the non-condo sector. This surge is largely attributed to a flood of new condo units, with 15,000 coming online in 2024 alone, marking a 78% increase from the previous year. The data also points to a pullback among multi-property owners, a once dominant buying group. These owners, comprising both investors and recreational buyers, have reduced their market activity since peaking in 2022. Interestingly, most of these owners hold just two properties, suggesting they're individual investors rather than large institutional players. The demographic of these buyers is shifting as well, with millennials now representing nearly 40% of multi-property owners, surpassing Generation X. Another notable trend is the shrinking presence of large investors. Those with portfolios of 11 or more properties have significantly reduced their holdings. In April 2022, they accounted for 13% of multi-property owners in Ontario, but today, they comprise only 7.2%. This contraction reflects a strategic decision by many to downsize their portfolios in response to rising interest rates and changing market conditions. Additionally, recent buyers who purchased at the market's peak in 2022 and 2023 have faced losses upon resale. Historically, about 2% to 4% of Ontario properties sell at a loss, but among those purchased during the peak and sold in 2024, a staggering 1 in 4 were sold at a loss. The median loss across the province was approximately $45,000, with the Greater Toronto Area seeing even higher losses at $56,000 and Muskoka facing a median loss of $240,000. First-time homebuyers are also feeling the pinch, with rising prices and higher interest rates pushing the median age of first-time buyers to 40 years old, up from 36 in 2014. This demographic shift is significant as it reflects broader macroeconomic challenges impacting affordability and accessibility in the housing market. Finally, homeowners are increasingly staying put, with longer holding periods for both condos and non-condo properties. In Toronto, for instance, non-condo owners now hold onto their properties for nearly 18 years, up from 13.8 years a decade ago. This trend is indicative of a more cautious approach among homeowners amid ongoing economic uncertainties, including interest rate fluctuations and potential mortgage policy changes. High borrowing costs are prompting Canadian mortgage renewers to consider drastic measures, as more than 1 million mortgages are due for renewal this year. The cost of borrowing has changed significantly since these mortgages were initially secured, most of which were at a time when the Bank of Canada's key lending rate was 1% or lower. This rate is now at least 3 times higher, creating a challenging environment for many homeowners. A recent survey from Royal LePage reveals that 57% of mortgage renewers expect an increase in their monthly payments, with 22% anticipating a significant rise. Meanwhile, a quarter of respondents believe their payments will remain within $100 of their current amount, and 15% expect a decrease. For those facing increases beyond their budget, options such as downsizing, relocating to a more affordable area, or renting out part of their home are under consideration. Phil Soper, the president and chief executive officer of Royal LePage, mentioned that while many Canadians have avoided worst-case scenarios like selling their homes, some will still face substantial rises in mortgage costs. This is putting added pressure on household finances. To counter this, many are looking at options to reduce monthly payments, such as extending their amortization periods, which has become quite popular. Interestingly, 8 in 10 expecting increased payments say it will strain their finances. However, 60% of these individuals prefer to explore other cost-saving measures rather than selling their homes. This includes reducing travel, cutting back on gas and groceries, and for 1/3 of respondents, curbing spending or investments. Around 25% are considering ways to boost their income, such as taking on a second job. Phil Soper further noted that despite financial challenges, Canadians continue to prioritize home ownership and paying down mortgages, even if it means cutting back on other expenses and savings. He pointed out that delinquency rates in Canada remain extremely low, arguably the lowest among advanced economies, despite rising living costs and household debt. There is a potential positive impact on mortgages from unexpected sources, such as tariffs on Canadian goods by the United States. If retaliatory tariffs are imposed, it may prompt policymakers to assist mortgage borrowers. Soper suggested that in a trade war scenario, the Bank of Canada might implement faster and deeper rate cuts to support a weakening economy, offering a silver lining to new homebuyers and those renewing mortgages this year. The Financial Services Regulatory Authority of Ontario, often referred to as FSRA, has taken significant action in the mortgage industry by revoking the license of Monarch Mortgage Group Incorporated. This decision comes amid serious concerns over regulatory noncompliance and integrity issues. In addition, Victor Peka, who was previously the principal broker at Monarch, has been denied a new mortgage broker license due to similar concerns. FSRA's decision was influenced by several factors, including Peka's provision of false or misleading information in his application for a mortgage broker license. This included not disclosing outstanding criminal charges at the time of his application, although these charges were later resolved without a finding of guilt. The application required Peka to declare any past guilty pleas or charges, to which he incorrectly answered no. Moreover, Peka failed to comply with essential industry regulations. For instance, he did not ensure that Monarch maintained errors and omissions insurance, a critical requirement for operating within the mortgage brokerage industry. Additionally, Monarch failed to submit necessary annual information returns for the years 2022 and 2023, further complicating their standing with the regulator. FSRA also highlighted Peka's lack of compliance with new licensing rules, which necessitate the completion of a private mortgages course for brokers. Despite multiple attempts by FSRA staff to contact Peka, he remained unresponsive, failing to address the regulator's inquiries adequately. This lack of communication and compliance raised substantial doubts about Peka's ability to conduct mortgage brokering activities in alignment with the Mortgage Brokerages, Lenders and Administrators Act 2006. The regulator's findings led to a conclusion that Peka's past conduct does not support the integrity and honesty required to hold a mortgage broker license. Consequently, Monarch Mortgage Group was deemed unsuitable to continue operating under its current license. Neither Peka nor Monarch contested FSRA's proposal or requested a hearing on the matter, resulting in the final decision to revoke the brokerage's license. This action is part of a broader crackdown by FSRA on non-compliant entities within the mortgage sector. Recently, the regulator also revoked the license of Shah Atta Hussein Faridi and imposed penalties on other individuals for similar non-compliance issues. FSRA's rigorous enforcement underlines its commitment to maintaining integrity and compliance within Ontario's mortgage industry. The Office of the Superintendent of Financial Institutions, often known as OSFI, has initiated a 60-day public consultation regarding updates to capital adequacy guidelines. This move is part of OSFI's ongoing efforts to bolster the financial stability of Canada's banks. The proposed changes aim to enhance the financial resilience and stability of deposit-taking institutions across the country. According to OSFI, the key proposed revisions to the Capital Adequacy Requirements Guideline and the Medium-Sized Deposit-Taking Institutions Guideline include adjustments to how income-producing residential real estate and United States government-sponsored entities are classified. Additionally, the changes propose aligning market risk rules with the Basel framework and updating the credit valuation adjustment framework. Importantly, the revisions also involve removing references to bankers' acceptances and the Canadian dollar offered rate, following the phase-out of CDOR in June 2024. Superintendent Peter Routledge emphasized that contributing to and supporting public confidence in Canada's financial system is OSFI's top priority. He stated, "The guidance released today provides financial institutions with a look ahead to our expectations so that they can reinforce their resilience to risk." In parallel, OSFI is pausing planned increases to the Basel III capital floor, citing competitive concerns for Canadian banks operating internationally. The decision to delay was initially announced in June after concerns emerged that Canada was progressing with the changes too rapidly, potentially disadvantaging its banks, while similar standards face resistance and delays in the United States. OSFI had intended to increase the Basel III output floor from its current 67.5%, which would have required banks using internal risk models to hold more capital. However, recognizing the competitive challenges faced by Canadian banks internationally, OSFI has put this increase on hold indefinitely, assuring that banks will receive at least 2 years' notice before any future changes are implemented. The significance of these capital rules cannot be overstated, as they ensure banks maintain a sufficient buffer to absorb potential losses, protecting depositors, and preventing financial crises similar to those experienced in 2008. While deferring the Basel Triple floor eases pressure on Canada's major banks, it raises questions about when or if the full rules will be implemented. Industry analyst Morningstar DBRS Inc. noted in a recent report that they anticipate a multi-year delay in Canada's adoption of the Basel III reforms. Nonetheless, they assert that even with the output floor at its current level, Canadian banks remain quite resilient to potential large economic shocks. This resilience is particularly crucial in light of heightened geopolitical risks and uncertainties surrounding United States policy changes, including tariffs, which could negatively impact the Canadian macroeconomic outlook and the banking sector. The public consultation is open until April 22, 2025, with OSFI planning to host a virtual industry day on March 6, 2025, to discuss these proposed changes. Feedback can be submitted to OSFI through their consultation email at consultations@osfi-bsif.gc.ca. This consultation period is an opportunity for stakeholders to voice their opinions and contribute to shaping the future of Canada's banking regulations. Our next topic takes us to Windsor, where the Canadian Mortgage and Housing Corporation, or CMHC, has released a new forecast for the housing market in 2025. According to their report, Windsor is expected to see a decline in housing starts this year, particularly in the multi-unit housing sector. This comes after a particularly strong year in 2024, where the city surpassed its provincial housing targets. It seems Windsor's construction boom might be taking a breather. The CMHC projects that the total number of housing starts in Windsor for 2025 will range between 1,550 and 1,950, which is a noticeable drop from the 2,157 starts recorded in 2024. This decline is primarily driven by fewer condominium apartment starts, with forecasts for multi-unit housing starts ranging from 1,050 to 1,350 compared to the impressive 1,657 starts last year. On a more positive note, the forecast for single-detached row and semi-detached housing starts shows a slight increase. The CMHC anticipates these starts to range between 500 and 600, up from 486 in 2024. This suggests that while the multi-unit sector might be slowing down, other types of residential construction are expected to pick up the slack. The report also highlights some potential impacts on the rental market due to recent changes in federal policies concerning international students. With a reduced demand from this group, The average rent growth is expected to stabilize and grow at a slower rate, particularly in areas near universities and colleges. This could lead to increasing vacancy rates in these regions. CMHC forecasts that the average rent for a two-bedroom unit in Windsor will increase by 2.4% in 2025, reaching approximately $1,420 per month. This is a more modest growth compared to previous years, reflecting the expected changes in rental demand. The CMHC's forecast is based on data available as of mid-January, and the full report, which includes insights for Windsor and other markets, is available on their official website for those interested in a deeper dive. That's a wrap on this segment about Windsor's housing market forecast. It's clear that while there may be some shifts in construction trends, the city remains a dynamic player in Ontario's real estate landscape. We'll keep an eye on how these forecasts play out over the year.